Welcome to Protect Your Assets Market Briefing. I'm your host, David Hollander, also known as the Sandman. Now let's get started. What a week. Macro factors that support the market have deteriorated a little bit since early November. So we're going to look this month at what's going on, particularly because we just got the inflation numbers that have been so long. Anyway, we just finally got them. Looking at December, the AI enthusiasm is still by far the biggest market influence, while the Fed rate cuts remain the second most important. And the third has changed a little bit since November as the 10-year Treasury has replaced stagflation concerns. Now, this was because recent economic data has pushed back on stagflation concerns, while the 10-year Treasury rose to not too much higher, but higher than thought because it was hovering around 4, and now it's moving back up again. So anyway, that's what's going on there. So let me bounce back to AI because I keep getting a lot of questions about, is there an AI bubble? Is it over? Are these stocks going to come falling down anytime soon? I call that AI enthusiasm. And so there's been some concern as we've been talking about the pace of CapEx spending on these data centers. Perhaps you've heard about the voluminous spaces you need to generate power to run this stuff. And so anyway, these data centers, along with the return on investment, these big investments, has surged over the past month. And those bellwether companies like Google, etc., Oracle's been in the light quite a bit, is the spending on AI infrastructure. And so if you look at Oracle as an example, that's negative right now on cash flow. They're actually spending more on that than what's coming in. So they're in a negative cash flow situation. Prior to September, the more a tech company was spending on AI, the more the stock would just rally. Now, this extreme spending is becoming, I don't know, some skepticism out there, some worry about cash flow and fundamentals, which again, when you're talking about tech, is that anything new? But anyway, it is what it is. So, now there's some restraint on overall AI investment, and that's what they're looking at. And over the past 6 weeks, I'll call it the AI robust enthusiasm. Well, it's limited a little bit. Now it's just enthusiasm. It's still intact, okay? Let's say that. Still intact, but we've seen some deterioration, obviously. All right, so turning to the Fed now, we also heard that the Fed was not going to cut rates like we thought near term. They did cut in December, which was good, but they signaled moving forward that they weren't going to do it. In other words, a pause. And that's not the same thing as the Fed becoming worried about inflation. And if you look at Thursday's numbers that came out on inflation, again, those were delayed because of the government shutdown. The November inflation number wasn't that bad. It was 2.7%, and the overall market was looking for 3.1. So again, that's positive. That's good. Not too bad. If you look at the 12-month inflation, what are we running at? Around 2.6, according to this. Again, the estimates were around 3%. So again, these are frankly decent surprises. And the reason when the Fed came out and said we're not going to, cut again anytime near term. So let's take a look at the 10-year Treasury. Well, we saw the yield this past week rise to a multi-month high. And again, the reason wasn't typical. It was concern over the next Fed chair, worries that Kevin Hassett would become Fed chair and that he keeps rates too low, too long to appease the administration. Well, that's resulted in the 10-year rising slightly. Like I said, it's going to bounce around here a little bit. But again, this move is not enough to hurt stocks, as we've seen again this week. And now, since all three market influences are seeing some deterioration, it's reasonable to wonder why stocks haven't declined much since November. And again, the reasons are for AI enthusiasm. It's still very much alive. The net result has been to push the tech sector a little bit lower. Second, while the new Fed chair looming, markets expect a more dovish Fed in 26. So even the hawkish change towards forward guidance not being reduced, it's just been taken with a grain of salt. Third, the economic growth, well, it stayed largely stable overall as you look at the market. We're right near Christmas, and investors want to see the market hold through the end of the year. as we talked about last week in statistics. You can go back and listen to that if you want to.
You can hear the Protect Your Assets market briefing on your favorite podcast app or as an Alexa flash briefing. Just search for Protect Your Assets market briefing. Links to subscribe free wherever you listen are at libertygroupllc.com/PYA briefing. The following program is paid for by Liberty Group, and the views and opinions of the host do not represent those of the station or its ownership. Investment advisory services are offered through Liberty Wealth Management, an SEC-registered investment advisor. Legal information provided on the air is not intended to be a substitute for callers hiring their own lawyers to advise them about personal legal matters. The information provided is general financial comment and cannot be relied upon for your specific financial situation. Investing involves risks, including the risk of loss of your investment. Please consult with a financial professional before investing. California Life Agent number 0B48569. You're listening to the Protect Your Assets Radio Network.